Welcome, everyone. Welcome to Managing Mortgages During a Crisis. My name is Jason Howell, and I'm about to go to the waiting room to see all the folks that are coming in to join us today. We've got a great group of people coming in today to listen to a presentation, not by me, but by Vice President Pat Holland of Embrace Home Loans. He's had a busy day, of course, because we're near the end of the month. Folks are trying to close and get business done, get in their homes before the start of the month. So we're really excited about having him here and so appreciative that he would take the time to join us. So once in a while, you'll see my eyes darting to the side as I look to admit folks into the room. As I said, it's a very, very exciting call here, conference with someone who's been doing this a while and knows it's actually what he's doing. So we're happy to have him. Pat, why don't you say hello? Tell us just about your day. How's it been?
Thank you, Jason. So it has been a busy day. We are in the mortgage business, much like the car business. At the end of the month, is try to let's get everything closed. We have a lot of settlements for clients that are buying homes right now and that are closing maybe a refinance that we've been working on for the last 30 days or so. And I know, even tomorrow, I have five purchase settlements tomorrow and 5 on Friday. So the activity is still there. Even with what's going on in the environment around us, we are still very, very busy. So it's been
you said
a busy day.
Five closings. That's 5 families getting into new homes today and tomorrow?
So 5 on Friday.
Okay.
And then tomorrow I have 7 closings. I think 3 of them are purchases and 4 of them are refinances. Today's the 27th. I only have two closings today, but I had 6 yesterday.
Wow.
So it's been a busy month.
Yep. Yeah, I believe it has been a busy month. And it's been a busy couple of months for you. I remember talking with you even in March about how busy you were. Tell us a little bit about that.
Sure. With interest rates absolutely going down to their all-time low, person's buying power has been, the dollar buys more home, as well as with a refinance. If they had an interest rate that was above 3.75, above 4, etc., them taking advantage of the low rates has been just an unbelievable opportunity for them to lower their monthly payments, increase their cash flow, and in doing so, they can pay off debt. They can just save it. There's just so many avenues. So, but yes, it has been and it's going to continue to do so. It's been very busy. It's going to continue to be busy for a while, and hopefully with interest rates being low and people being able to save or restructure their mortgages, that will actually help stimulate the economy in a different way as well. That when people have more money to spend, they either when they have more money staying in their pockets, they'll either do one or two things. Maybe 3 things: pay off debt. Number 2, they might spend it in the economy, which is great. Or number 3, they'll maybe invest it and save. And that's where, mortgage planning is such a crucial part of financial planning, which is, why we work so well together, because it goes hand in hand.
Yeah. Where are you now, Pat?
I'm taking advantage of a 78-degree day. I'm it's on my back patio, and I've got you can't see him, but I've got my mortgage dog right next to me, hanging out, and we're just kind of relaxing.
Oh, that's great. Then what we'll do now, I got a friend of ours that said, hello. Hi, Maddie. Great to see you, or at least to know that you're there. Well, we're going to get started here in just a couple minutes, since a lot of folks have joined that we expected to. And the good news is, and I think a lot of our viewers are starting to recognize this now, we record these videos. We, of course, are live on Facebook. And so anyone who's on Facebook can jump on and check out what we're doing. But we will have this recorded and on YouTube and out to everyone again tomorrow. And I'll share it with my social media. Pat will probably do the same. So you will have access to this in case you need to jump off early or don't get your question in. And you will most certainly have Pat's information. I think that's most critical for today. A couple of housekeeping items. Number one, I didn't put all of you on mute. So that gives you a little bit of freedom, all right, to jump in and ask a question. But should you be so shy, go right ahead in the chat. That's the place to ask questions. After Pat goes through a very brief overview of a few bullet points that we talked about in the newsletter, we're going to open it up for questions. This is for you, all of you who decided to come live. That's what this is for. We really want to be able to help you answer questions that are current today. And the mortgage business, the house business, all of that is incredibly current these days. So please put your questions in the chat and they will get answered. All right, with that, I'm going to go down here and share the screen. That is the screen of all screens. And now we can get to our presentation. So if you came to Maximizing Mortgages During a Crisis, you came to the right place. And we'll go for as long as folks have questions, we'll go. Did you say something, Pat? Okay.
No, I'm good. No, I'm fire when ready.
Okay. Great. Get to our next slide. So this is Mr. Patrick Holland, our featured speaker today. I've known Pat for a number of years, probably over 10 years at this point. Yes, he's a loan officer who's done great things over the years, and he'll touch on some of those. But he's also been a friend. We go to a networking group, see each other once a week. But more than that, I teach a class at American University, and part of it is mortgages. And I figure, why should I teach it? I should bring a guy like this in. And that class is 8 p.m. to about 10:30, 10:50 p.m. And so it's late on a Monday night. And Pat has come, I think, what, 4, 5, 6 times now, Pat, to teach the class?
I think it's, and it's every semester. I think we're going on 3.5 years now. So
yeah. So that'd be about 6
and we would have done the fall semester are we actually the spring semester if we could have done it.
Yeah, I think you were able to get in and do it. You've done so many.
Actually, you're right. We did. Yes, we did. Right, just in time. Just in time.
So your streak is alive, which is just terrific. So thank you for that, Pat. Publicly, I'm happy to say that. And I also just want to say, on a professional side, there are a lot of people in the mortgage business. A lot of people can get you in a mortgage. Pat can certainly do that, but he's going to do it the right way. He's going to make sure that it's part of a comprehensive financial plan, which he'll touch on some more. It's a big reason why I appreciate and I trust Pat with my clients. And I think you'll trust the Q&A session you'll have here. And if there's more you'd like to do with him, as I said, his contact information will be available. But with that, Pat, can you tell us a little bit about Embrace Home Loans and why you choose to hang your shingle there? You have for years, and maybe what they're doing during the pandemic.
Absolutely. So, and I appreciate the warm welcome and sentiments. And we think and we take care about our clients in I think a moral and ethical way that it's not always appreciated, but we want to make sure that we're always do it the right way, and that's how we kind of live our motto credo by. Embrace Home Loans, we are a direct mortgage lender. What that means is our entity, the only thing that we do are mortgage loans for residential financing. So when a client comes to us, it is always has to do with either buying or refinancing a mortgage on a residential property. We are doing business on a daily basis, although it being a little different right now. Our offices are just starting to reopen. I'm going to start going back to my office a little bit each day come next week in accordance with our local laws. Some of our other offices have opened up a little sooner, the ones down in Florida and everything. But we are 100% like we haven't skipped a beat. In fact, we've been doing more loans, more business than we ever have in the last 3 months, and you would never know we weren't all in our offices. We are COVID ready. All of our platforms are digital. Our clients have access to secure website portals where they can upload their secure documents, and be readily available in terms of when checking on the statuses of everything. I mean, it's been as smooth as silk. And even before we closed our offices, our company, about 30 days prior to making the decision, we had the foresight to order at-home workstations for just about every employee. So if they didn't have a computer, if they didn't have the essential tools, they got them, and they were all up and running in a timely manner. So it's been great.
And Embrace it's not a bank, but you
Yep.
still are able to do this servicing loan thing. Maybe just spend 30
Absolutely.
seconds on how you're able to do that.
Sure. So as a direct mortgage lender, we do actually have a servicing portfolio as well. So some of our loans we do transfer post-closing. All of the loans have to meet the minimum requirements by Fannie Mae and Freddie Mac or the investor that we've done the loan with. Once the loan is complete, we either will transfer the loan to a new servicer, or it'll remain on our servicing portfolio, which our clients will be paying, their monthly bill, just like a rent or anything else. Just they'll be paying it to Embrace Home Loans, care of our inside servicer. But we are, yep. So that's what we do.
No, terrific. Thank you, Pat.
Yep.
And just as a point for everyone here, some folks may be new. My firm is Jason Howell Company. We're a family wealth management firm. Been around for about 5 years, and I've got a business partner. We've been recognized in a few places that we're really proud of. Of course, we're most proud of having 2 certified financial planners as part of the team, and then being named to Washingtonian's top wealth advisors just last year for the first time ever. So we're starting to make an impact in the community here in the DC area, even though we have clients outside of the area. And we continue to do that, not just on the investment side, but in 3 areas when we go through financial plans. And one of them is doing the recommendations that most firms do. But we also have an implementation guide as our second tool, so that a lot of people can go in and actually digest what can be 40 to 50 recommendations. The third thing we do, which is pretty unique to our firm, is spend some time around family governance. And I really believe this is the sort of the next level of financial planning. It helps incorporate other professionals like Pat. When it comes to mortgages, that's a real big decision. How long do you pay it for, and what interest rate would you accept for your family? But beyond that, why buy a home? What's it for? What's it going to do for your current family? What's going to do for the next generation of your family? All of that goes into something called a family constitution. So our clients walk away or stay with us with having recommendations, a guide for implementing those recommendations, and then a real sort of non-financial family governance, family constitution about how to live their lives and make decisions going forward. And we believe if we can help people make decisions about their lives, then they'll be able to make the decisions that make their lives a lot better. So that's really why we are around. But without further ado, we're going to get into some of the questions now that we promised we would have answers to with Pat and a couple others that we threw in there for good measure. So Pat, take it away. Here is your Q&A that we queued up for you. And the first question is in and around forbearance, since a lot of people have been asking about that. Tell us the latest and greatest.
Okay. So the big thing about forbearance is, and there are a lot of misrepresentations that are actually out there on social media, in the news. I even had a client of mine just actually inquire with their servicer. They didn't ask for it. They just inquired about it. And a week later, they found out that the servicer put without even just for even making the phone call. But forbearance is basically a short-term forgiveness on making a monthly obligation or making a monthly payment on an obligation that you have. Since we're talking about mortgages, we'll just say that obligation is a current mortgage. So forbearance means, well, okay, I may not have to pay it for a predetermined time, whether it's 3 months, 6 months, 9 months, but at some point, lender is going to ask for that money to be paid back. This is where you have to be very, very careful. You want to find out, well, what are the repayment terms? Does it get tacked on to my loan? Does it get repaid at the end of the 3 months, at the end of the 6, end of the 9? I've heard a couple horror stories, unfortunately, that that lump sum needs to be paid back right there at the end of the 3 months. Well, if someone who might be out of work or may not be able to pay that mortgage, well, they're not going to have that lump sum in that 3 month period or that 6 month. So you definitely want to know exactly what you're signing up for or even inquiring about. But one of the good things that we just found out today, if an individual did start forbearance, but they and it used to be, well, if you took forbearance, you weren't going to be able to refinance for a 12-month period. I've had a couple of clients that actually caught up with their loan, their current. They are now able to qualify for a refinance. So you just want to make sure that before you take advantage of the situation, one, do I really need it? It may seem un-American, or that individual is taking advantage of the situation when they haven't lost their job, or they haven't had a change that would allow them to do this. And I won't go into too many opinions here, but the big thing here is this is designed for this. The forbearance is designed for individuals that have come on some type of a hard, and they should not feel bad for taking advantage of this hardship because, when they need it. And I'm hoping that the right people are able to take advantage of it in the short term.
And Pat, I have a question about that.
Yeah.
I had seen, I think it was maybe a week and a half ago, that there was some new communication about forbearances, and that if you did take this time to forbear and it was approved by your banker, then in 3 months or so, instead of it being the lump sum, you would go back to your mortgage, I guess, holder, if that's the right terminology, and they would work out something with you. It'll either be tacked on to the end of the mortgage, it may adjust your current mortgage payments, but you kind of have some flexibility there depending
There's
on
some options.
Okay.
Absolutely. So they've gone from having one repayment to what I understand, every servicer and lender are going to be slightly different on this, but the clients actually do have some options now. And depending upon an individual's new status, once they are like, okay, I have the ability to now either repay or make some, I would definitely educate yourself on all the options, the pros and the cons, so that before you agree to one of the new terms, that you think about, again, you want to make sure you understand all of the options are available before you make a decision. But once you do make that decision, I believe that is it. I'm not involved with the modification side too much. And I haven't been on enough calls to give too much advice on this part. So I want to be careful that I don't say the wrong thing.
Sure.
But obviously, everybody do their own research with their own lender and their own servicer to know that you are making the right decision.
Okay, and that works, and I think that's just good advice in general. You're going to provide a resource here for folks that ask general questions, but of course, it's going to be a conversation with your personal lender. We'll talk a little bit about how hard it is to qualify for a home these days. I've heard people getting, employment checks on the day of closing. Is that what you're seeing too?
Yeah. So in terms of qualifying, there are a few additional checks and balances that are going on throughout the mortgage process. The actual process hasn't changed a whole heck of a lot. There are some new guidelines that are in place, maybe some credit overlays that weren't quite there. Ago, we prided ourselves at Embrace Home Loans of actually having no additional overlays, meaning that in guidelines by the investor, that we may actually have some company guidelines. We followed the strict guidelines set forth by Fannie Mae, Freddie Mac, investor. But currently, what we've seen is, okay, we now have to put in maybe some credit score guidelines. Over the past 60 days, we have seen, and correct me if I'm wrong, Jason, but the single largest unemployment increase in a 60-day period um, in our company, in our country's history. I think I read that somewhere where
Yeah,
we're
not,
seeing.
I mean, numbers not since the Great Depression, but as far as the speed, I believe it's unprecedented.
That's okay. So that's appreciate that. Individuals that are unfortunately at no fault of their own being unemployed or furloughed or laid off short term, that affects an individual's ability to repay, ATR. So that is an abbreviation. So during the Dodd-Frank and the TRID updates in October of 2015, lenders have to stipulate and assess the ability to repay any mortgage that is being approved for. So right now, an individual's ability to repay is questioned all the way up to the date of settlement. So a couple things that what we're doing is, and I actually have a couple people that are on this call. I appreciate them joining that are closing mortgages. I'm so happy for them on Friday. Well, today is the 27th. Tomorrow they will be logging into their online website and attesting that they have not lost their job, that their income is the same, and that their hours are the same. It is a, and um, we have to make sure that those individuals still have the ability to read the loan. So that's one thing that's happening. A borrower's income and assets still the same. We follow the guidelines of the loan that they're qualifying for. So that hasn't changed at all. If an individual is self-employed, well, there are a few new self-employment requirements that they have to have a few months more of additional reserves in place in order to qualify. Because right now, depending upon the industry that you're in, self-employment income is down. We are seeing that, and I hate to make a broad stroke there, but it is self-employment, depending upon what industry that you're in, not letting people in homes to do certain home improvements. There are, sales and maybe carpets. I'm just using some examples, if carpet installations or HVAC services, or um, again, just in general, they might not have the same income level 60 days ago. Now, I'm happy to say that we are seeing a lot of those industries not skipping a beat. But if you're in the restaurant industry, for example, we are seeing a large amount of employees or individuals in that line of work that we're seeing their income drop pretty drastically. So unfortunately, those individuals are having to jump through a few more hoops right now.
Got it. Got it. Well, let's do this. Let's step back a little bit and let's talk about mortgages and how they fit into a financial plan. I mean, this is something, this picture we have here of you was from American University, one of the classes that you taught
Yep.
for us. And I know you like this topic, and I always appreciate when you bring it to the students. How does a mortgage fit into a financial plan overall?
I mean, this is where I truly try to differentiate myself from a loan officer that is just trying to help somebody get a loan. Nothing against that. I mean, I don't. But in my big assessment, I take a holistic approach with my clients, making sure that they understand that a mortgage is a liability, but the house is an asset. So you have two avenues there that we have to make sure that when we are assessing what an individual is going to be paying on a monthly basis, and we're substituting that for maybe rent that they were paying, and we want to make sure that they can still plan for the other very important items of their life, such as if they have a family, do they have education to plan for? Do they have daycare expenses? Do they have other debt that we want to make sure that we can still continue to pay off? Are we going to keep planning for a vacation every year? Do we have enough insurances in place, to make sure that we have short-term and long-term insurances to cover any situation that might happen? I want to make sure that when a client is getting ready to buy that home, that we can still enjoy our life as we know it, that we're not going to put them in a mortgage or a plan or a house that is going to have a negative impact on their daily life. We don't want them to be called, or become what we call house poor. We want to make sure that that house fits into the plan, excuse me, like it's just another part of how they would be allocating their monthly after tax take home pay. And if done correctly and if done with a plan, a home is a great way to create long-term wealth. If it already has a loan, when they come to me, look at one of the first questions I have is, do you have a financial planner? And more importantly, are you actively involved in a financial plan that I can make sure that I'm only putting mortgages as options in front of you that follow that plan? A mortgage done the right way can accelerate wealth. A mortgage done the wrong way can be that ball and chain that can prevent long-term wealth. And that's how I try to assess every plan.
Got it. No, that's terrific. Well, let's get a little more detailed then. One of the things that I think is really difficult, and sorry if my video's not on, is for people to sort of assess, how do I know sort of generically how I might qualify for a loan before I go see someone like yourself? Tell us about the debt to income ratio requirements.
A great question. So what I always try to talk to my client before I even pull credit report, just have a very open dialogue with them is, okay, let's talk your income, and I'll put that. Let's talk about the current obligation you have now. More importantly, how long are they going to be in place? Are they term installment obligations or are they revolving obligations? An example of a revolving obligation might be a credit card that you actively, like, and I'll speak for myself, I use my 2 credit cards. Now I do lots of closing gifts. I invest in myself for advertising and stuff. So I have revolving expenses that I put on my credit cards, but I pay them off every month. An installment loan might be a car payment that has an end date that might be gone in 32 months or 21 months or something like that, or a student loan that might be expiring short term. So we take a look at all of the monthly obligations that a client currently has now, and we look at what that monthly payment is. And then we also take into account what that potential mortgage payment that might be. We take those items, and that would be the debt, and we divide that by the client's monthly income. Therefore, that's what we call debt to income ratio. I personally am, and some people say I'm a little conservative when it comes to how aggressive somebody might be with acquiring a mortgage. Take into consideration things that might not be on a credit report that they may have, like such as childcare expenses or other obligations that might not show up on a credit report. I want to make sure that we're looking at all of those items when we determine a debt to income ratio. Depending upon the loan type an individual might be going for, those is percent, 43%, 45%, or even higher, depending upon the type of loan. But as a rule of thumb, I want to make sure that the client has that mortgage without worry.
Hold on a second, Pat. You kind of skipped up a little bit. I'm not sure if you're maybe too far from your internet connection.
Oh, sorry.
But go back to about 2 sentences.
Okay, so when I'm putting together that potential mortgage for that client, I want to make sure that we are, excuse me, not putting them in a position that they cannot comfortably make that payment on a monthly basis and still take care of their other obligations, plan for retirement, plan for education, plan for that family vacation. We want to make sure that we are not making a life-altering event, but a joyous, life-changing event where now they own a home and they can continue down that path with the security that they should not skip a beat when they start getting those mortgage payments coming due on a monthly basis.
So generically, like if I make $100,000,
yep,
you're going to look at a percentage of that and say, you know what, all of your revolving debt payments, at least the minimum, including the mortgage, need to be about a third of that. So
again, conservatively, I would say you should not be spending more than 35% of your gross salary on your monthly obligations and mortgage payment, because you want to make sure that you still have the ability to pay off or to properly conduct savings. That savings could be whether it's 401k, whether it's investing in mutual funds or some type of other investments that you have that you're planning for retirement. Because when you have a significant mortgage payment, you are not able to take advantage of the other areas that you should be planning for.
Got it. And I just did the math, and one day I'll be really awesome at switching to whiteboard. Really confident in doing that. I'm not so confident today, but $100,000 a year, that's $8,333 a month, and 35% of that is just about $3,000. And so that would mean, your mortgage and all your other revolving debt payments would need to be $3,000 or less. You could get a loan by somebody, because some people will shove you into a loan if they can. And we saw what happened with that in 2007 and 8. But with Pat Holland and other sort of reputable folks, they're going to say, you know what, if you don't have more than $3,000, or $3,000 is the limit on all your expenses revolving every month, before we would issue a loan. Because in part, even that 8,333 is a gross number. It's a kind of an inflated number. You have to pay taxes. You probably have a 401k, deduction, a health insurance deduction. So you're being even a little bit risky in some ways by even allowing for a third of your gross to be your expenses. Is that right?
I'll say that with a yes, but it all depends on an individual's position. I have some individuals that their income levels may not be really high, but because of some other very stable parts of their portfolio, like maybe they already have several hundreds of thousands of dollars in some other savings or other things, that we might push the limits for some individuals where it might be okay for some, but others. Again, that's why we don't want to just put everybody in that same class. We want to make sure that a mortgage is an individual obligation and an individual plan.
Got it.
And they take the time with client to client to client to make sure that, maybe only one person is on the loan, but there's a second individual in the home that will be contributing to that payment. In that instance, I don't mind taking that person to a higher debt to income ratio, knowing that we have those additional funds available. So every situation is different. That's why a good, honest assessment is needed to properly advise the client.
Got it. And I've got a double barrel question for you, Pat. Number one, the difference between a conventional and jumbo mortgage. And number two, who's that furry guy behind you?
Oh, do you see Tucker? Oh, he's okay. Gotcha. He went up there. So that is Tucker. That is my mortgage dog. He is, he's my buddy. He doesn't leave I think he's actually getting a little warm and wants to go inside, and he wants to go inside right now. So I'll probably do that in a second. But so talking about the different mortgages now, being that we are in the Metro DC area, we actually have 3 classifications of mortgages in our area. The national level for a conforming loan is $510,400. So that whether you're in Alabama, or if you're in South Dakota, or if you're in Virginia,
Montana that are here today. So Montana.
Yep. So yeah. Okay. So you have a conforming loan is $510,400. Now in our area, because we have this is defined by the median house or the median loan average. We have an area in this area. We are in an area that has what's called a high balance conforming loan. A high balance conforming loan goes all the way up from $510,401 to $765,500. So if you are in that, so you can buy a $780,000 home with 5% down and still get a high balance conforming loan. Now, a jumbo loan is when your loan amount exceeds the maximum high balance conforming threshold for whichever area you live in. And you can go online and Google conforming loans. You can put your zip code in, you can put your area in, and it will spit out the conforming and the high balance conforming loan to get some more information on that. But a jumbo loan is a loan above that threshold, and that is typically you'll have to follow investor guidelines. That is a non-conforming, non-conventional loan, and now we are subject to whatever the investor guidelines are. Right now, jumbo mortgages are a little harder to come by. In fact, a lot of banks and a lot of lending institutions have kind of slowed down jumbo lending in the current environment that we are, and that'll be a short-term dilemma. It will come back. It will come back very, very, I'm hoping very quickly. And then we'll just be subject to whatever the lending guidelines are at that time. We are still doing jumbo loans, whether it's an adjustable rate mortgage or a conventional. We still have them, but just some of the guidelines have changed in terms of credit score requirement and down payment requirement.
Got it. And I guess the big point to pull from that, Pat, is if you have a conventional loan, you've got more options when it comes to working with your lenders. Whereas a jumbo loan, it's typically a little more restrictive. So a higher balance requirement loan, more restrictive, and it's just something to consider in your plan.
More income, more assets, and a higher credit score. Yep.
Got it. Okay. Well, we're not going to keep you outside too much longer. Tell us your dog's name again.
Oh, Tucker.
Tucker. Yeah. We don't have any questions.
He's an Australian Labradoodle.
The Australian and hypoallergenic, I believe, right?
Absolutely.
If you have any questions for Pat, please, speak now, forever hold your peace. You can send them in the chat. Of course, Pat's contact information is right here on the screen, his email address and his phone number. For those of you who are just listening on your phone, that email address is pholland@embracehomeloans, all one word.com. And the phone number is 703-505-2022. Pat's lived in the area how long now?
I moved up November of '99, so I have been a Northern Virginia resident for quite some time now, 20 plus years.
Yeah, we're happy to have you. I had sent a couple details ahead in the newsletter about your PGA golf escapades, and I think that's coming up for you. This is the season for you in golf, isn't it?
I'll tell you what, I would like to be able to get out of. My skills have greatly diminished because I'm working so much and with the family obligations. But small sacrifices. I'd rather spend the time, doing with the kids. But I'm glad that both kids actually like getting out, as long as they can drive the golf cart and they can take advantage of that and get a snack while we're out there. Both of them like to get out and play, so it's good.
No, that's terrific. All right. Well, we haven't gotten any other questions today, or right at this moment. So I'll stop the share. I'll bring us back to big faces that are on the screen. I just think this has been it's been a good presentation, a good introduction to the kinds of things that you'd like to know about if you went and sat through a first-time homebuyers class. Of course, there's a lot more to go. Pat Holland has always been a great resource for me, so please allow him to be a resource for you if you have further questions. A reminder, I'm going to record this, or this is being recorded, so I will send this out to all the folks who joined and even a handful of folks who weren't able to join today. Before we go, Pat, are there any just final remarks you have about the mortgage environment that we're in today and anyone who's planning to buy within the next 6 months?
I would just reiterate that proper planning is very key right now. Know your limits, know your budget, define a budget, and just make sure that you're educated as you get ready to go through the process. Have some guardrails up in terms of price ranges for the homes you might be looking at. But like I said, the beauty right now is your dollar is buying more home than it did, even 6 months ago. I have some clients, a couple actually on this call right now, and I'll, so wave to you guys, you know who you are, that they bought a home at the end of December, and we're going to be refinancing them literally in less than 30 days because the interest rates have dropped for them enough that it makes financial sense to make the investment in another program where you can take that monthly savings that we're going to be getting from the refinance and apply it to, if you have other debt, great. You just need to save it, fantastic. Or, hey, apply it to some future purchase that you're going to make. But restructuring a mortgage that allows you flexibility to save, invest, pay off debt, increase cash flow, it's a great time if you can take advantage of the programs that are available. And that just takes a phone call, some planning, and an open mind.
Well, thank you so much, Pat Holland, Vice President of Embrace Home Loans. Everyone, you've been a wonderful audience, although quiet. Happy to have you. Thank you for being here with us. This will be recorded. It's been brought to you by Jason Howell Company. For more information about us, just go to jasonhowell.com. And until next week, stay healthy and stay safe. Take care, Pat.
Thank you very much for having me, Jason.
You bet.